Hello and Happy New Year. Welcome to our first MarketCast of 2024, where we'll recap last year's highlights and share our investment ideas going forward. After getting off to a slow start, 2023 turned out to be a good year for both stocks and bonds, as the inflation genie, which had been haunting investors, finally got pushed most of the way back into the bottle. Looking ahead to 2024, we see some new genies that are threatening to come out and disrupt the markets. Banking instability, domestic and geopolitical tensions, government debt, inflation, recession, and something we call crowded trade risk. These are all things that could upset the financial markets this year. And as we face these uncertainties, we think it's important to consider not only our central expectations, but also the wide range of potential outcomes that could occur under different scenarios. Our goal this year will be to build portfolios that are diversified and resilient and can perform well across a wide variety of scenarios, both expected and unexpected. So, what are our best ideas for 2024? Let's start by reviewing the past year to see what the markets are telling us. Here we see two remarkable and somewhat unusual things that we think 2023 will be remembered for. First, we see the towering outperformance of U.S. large cap stocks in 2023, which was mostly driven by just 7 giant technology leaders. And while this could be called a narrow rally or a crowded trade, investors in large cap stocks were very happy to have experienced a strong year. But we also noticed that large cap leadership has started to fade in the fourth quarter, with small caps taking the lead and international and emerging markets also starting to participate. And there's a second remarkable thing that stands out. When we compare the teal and red bars, we see that the vast majority of last year's performance arrived in the fourth quarter, which was when the Fed unexpectedly shifted its future interest rate outlook from rate increases to rate cuts. We look at this sudden market rally as a critical reminder of how important it is to stay invested throughout the year. Last year was also a good year for defensive investments. Bonds, hedge funds, and cash equivalents all beat inflation by a healthy margin. In fact, in the fourth quarter, bonds had their best quarter since 1989. So now, to look more closely at our outlook and investment ideas going forward, I'll turn it over to our Chief Investment Officer, Bryan Shipley.
Thank you, Reegan. When we think about portfolio ideas for the future, we like to start by looking at the recent market cycle. And here we can see that in early 2022, stocks and bonds both fell into a deep bear market. This caught a lot of investors by surprise because normally stocks and bonds tend to move in different directions. But at the time, we saw that risk and had already shifted our preference to low duration and hedge strategies as an alternative. Even today, we still maintain those same preferences, but to a lesser extent as market conditions normalize. So now, 2 years later, we can look back and see that stocks and hedge strategies have both wound up at roughly the same place, but with hedge strategies having a much smaller drawdown than stocks, which is consistent with their role in the portfolio of reducing volatility. We also notice that intermediate bonds are still well below break even on a 2-year basis, despite having had a great fourth quarter. But we can also see a potential path forward for bonds. When we look at the top dashed line, the 10-year Treasury yield, we can see that yields are still fairly elevated. And that means that bonds have a lot of potential for future gains if yields continue to decline, as in a recessionary scenario, for example. So at this point in the market cycle, we think that all 3 investment categories, stocks, bonds, and hedge strategies, have the potential to benefit investors, either through return generation or risk reduction. Now let's look a little bit more closely at stocks. This chart shows how narrow the leadership has been for the S&P 500 last year. Over the past 12 months, the Magnificent Seven, Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, and Tesla, climbed an amazing 79%, far more than their earnings grew, while the remainder of the S&P 500 index only rose about 14%. While we think these are great companies, we also see this as an example of investor herding. And like the tech bubble of the late 1990s, it's something that could easily reverse itself over time. In fact, in the fourth quarter, we saw the stock market leadership begin to rotate to smaller companies as the market rally began to broaden out. So do we think smaller companies have the potential to outperform larger companies going forward? Well, here we can see the price ratio between the Russell 2000 Small Cap Index and the Russell 1000 Large Cap Index over the past 30 years. When the line goes up, it means that small caps are more expensive relative to large cap. And when the line goes down, it means that small caps are relatively cheap compared to large cap. This chart shows that despite the strong fourth quarter small cap stocks had, they still look relatively inexpensive compared to large caps, which means that there's still a lot of room for potential outperformance. Small caps are often young companies that have significant growth potential, which can make them an attractive target for both skilled investment managers and also private equity firms. And given their small starting size, these companies can also potentially expand more percentage-wise than giant companies over the long term. Bearing in mind, they also can have more volatility. So we continue to find small caps to be relatively attractive. But where do international stocks fit in? Over the past 5 decades, equity leadership has alternated between the US and international stocks. The most recent period of strong performance was from 2008 to 2021, when US stocks outperformed. But lately, things seem to be changing. Over the past 2 years, there really hasn't been a clear leader. So given today's elevated US large cap prices and the tendency for regional leadership to rotate, we think an allocation to international markets is a prudent diversification strategy. Now let's look at what's happening within bonds. This chart shows 30 years of treasury yields as the red and green lines, and 30 years of inflation as the dotted line. And over here on the right, we can see two things. First, we see that not only has inflation recently peaked, but also the 10-year treasury yield looks like it's starting to fall. These could be signs of a cooling economy. It's worth noticing that the past 3 recessions were accompanied by declining inflation and declining bond yields. So we think it's possible that we could be headed into a slowdown or a recession in 2024. The second thing that we see in this chart is that treasury yields are still near 16-year highs and they're above trailing inflation rates. This is a big change from a few years ago when treasury yields were much lower than inflation. So today, with bond yields running roughly in the 4 to 5% range, bonds not only offer attractive interest income, but they also offer significant potential for price appreciation if yields continue to decline. And when we think about possible future scenarios, it's our view that if yields were to fall quickly across the board, we'd expect longer duration bonds to outperform. But if yields were to fall slowly or not at all, then we'd expect the higher yielding shorter duration bonds to outperform. And since both scenarios are possible, we think it makes sense to use a blend of both short and intermediate maturities. It's our view that given today's relatively high yields, such a blend should have a high probability of delivering a positive return in 2024. So now, to put all of our ideas together in a portfolio context, I'll hand it back to Reegan.
Thank you, Bryan. While we continue to see long-term value in every asset class, we do have some shorter-term or tactical views. For example, given the current yield structure, we're still favoring cash and low duration for their high level of income and stability. And while we think the return outlook for fixed income is actually generally positive, we view lower yielding intermediate bonds as being less attractive on a relative basis. Among global equities, our broad view is neutral, but we also see the potential for some rotation away from higher priced growth stocks towards more reasonably priced small and international stocks. And as we continue to lean into hedge strategies for risk management and as a source of dry powder for potential future equity purchases. But please keep in mind that markets are dynamic and that these views can change over time. Your advisor will work closely with you on specific opportunities as they become available. We recently updated our capital market assumptions. These are the big picture numbers that we use to calculate the expected return and volatility for client portfolios. These assumptions are for a 10-year time frame, which we think makes sense for most investors. Looking out over the next decade, we're seeing almost every asset class having an expected annualized return of 5% or more. There's only one asset class that we expect to return less than 5% over the next decade, and that's cash and low duration. And that's because even though money markets currently yield more than 5%, we expect short-term yields to decline over the next decade, which would reduce their long-term return. On the other hand, when it comes to the higher performing asset classes, we expect private equity, emerging markets, and international stocks to be among the best performers for the next 10 years, although we do expect these investments to be more volatile. If you would like to know more about your portfolio's expected long-term return and volatility, please contact your advisor. We are proud to be recognized as a Real Leader Top Global Impact Company for the 4th consecutive year. Real Leaders ranks the top impact companies from around the world, and we are honored to be named among this group of visionary leaders. We also want to take this opportunity to thank Peg Terry and Jillian Perkins, who just celebrated 25 years of employment with Arnerich Massena. Jillian is the driving force behind these videos and other communications, and Peg makes sure our client reports are perfect. Both are such a pleasure and joy to work with. Thank you for joining us today.